Portfolio rebalancing is one of the least exciting actions an investor can take, and for that very reason, it is one of the most powerful. It does not promise higher returns, better market timing, or clever insights. Instead, it quietly enforces discipline in a process that is constantly being pulled off course by markets and emotions. Rebalancing exists to answer a simple but uncomfortable truth. Left alone, every portfolio will drift into something you did not intentionally choose, usually at exactly the wrong time. At its core, portfolio rebalancing means adjusting your holdings back toward their intended allocation after market movements have pushed them away. When some assets perform well, they grow to represent a larger portion of the portfolio. When others lag, they shrink. This drift is not inherently bad, but it becomes dangerous when it happens unconsciously. Over time, portfolios tend to concentrate in what has already done well, increasing risk, just as future returns often decline. Rebalancing is the act of interrupting this cycle before it turns discipline into accident. One of the biggest misunderstandings about rebalancing is the belief that it is a form of market timing. It is not. Rebalancing does not attempt to predict tops or bottoms. It responds to relative change, not forecasts. When an asset becomes a larger part of the portfolio, then intended rebalancing trims it. When an asset becomes smaller, then intended rebalancing adds to it. This behavior feels counterintuitive because it runs against momentum and recent performance, which is exactly why it works as a behavioral tool. The need for rebalancing arises from the same force that creates returns volatility. Without volatility, portfolios would not drift, and rebalancing would be unnecessary. Volatility creates dispersion between assets, and dispersion creates opportunity to realign risk. In this sense, rebalancing does not fight volatility, it uses it. Investors who rebalance consistently convert market movement into structure rather than stress. Timing is where many investors struggle. Some believe rebalancing should happen constantly, reacting to every small change. Others avoid it entirely, waiting for a perfect moment that never arrives. Both approaches miss the point. Rebalancing is not about precision, it is about consistency. It should happen often enough to prevent excessive drift, but not so often that it becomes trading disguised as discipline. The goal is to intervene at a frequency that supports long-term intent, not short-term emotion. Another critical element is understanding why you are rebalancing. Rebalancing is not done to improve returns in every period. In fact, there will be times when rebalancing appears to reduce performance, especially during strong, persistent trends. This can feel frustrating. But the purpose of rebalancing is not to maximize returns in favorable conditions. It is to manage risk across all conditions. It protects against overexposure, not underperformance envy. Taxes, costs, and liquidity also matter. In taxable accounts, rebalancing can trigger capital gains, which may reduce after-tax returns. This does not mean rebalancing should be avoided, but it does mean it should be done thoughtfully. Using new contributions, dividends, or withdrawals to rebalance passively can reduce tax impact. Placing tax-inefficient assets in tax-advantaged accounts can also make rebalancing less costly over time. Rebalancing is most effective when it is integrated into the broader portfolio structure, not treated as a standalone action. Emotion is the silent opponent in rebalancing. Selling assets that are performing well feels like abandoning success. Buying assets that are underperforming feels like admitting a mistake. These feelings are universal. Rebalancing works precisely because it forces investors to do what emotions resist. It replaces narrative-driven decisions with rule-driven ones. Investors who rebalance without rules often stop when it becomes uncomfortable, which is usually when it is most needed. It is also important to recognize that not all assets need to be rebalanced equally. Core allocations, such as stocks and bonds, often benefit most from disciplined rebalancing. Tactical or satellite positions may require different treatment, depending on intent. Rebalancing should respect the role each holding plays in the portfolio. Blindly rebalancing everything the same way can undermine strategy rather than support it. Perhaps the most valuable benefit of rebalancing is psychological. It creates a sense of control without requiring prediction. Investors who rebalance regularly tend to worry less about market movements because they know there is a plan in place to respond. This reduces the urge to make impulsive changes during periods of excitement or fear. Over decades, this calm consistency often matters more than any single asset decision. Portfolio rebalancing, then, is not about chasing optimality. It is about maintaining alignment. Alignment between risk and tolerance, between goals and exposure, and between intent and reality. Without rebalancing, portfolios slowly drift away from these anchors. With it, portfolios are gently guided back again and again through cycles that no one can predict. As with many disciplines in investing, the hardest part of rebalancing is not understanding it, but executing it when it feels wrong. Knowing when to rebalance, how to do it efficiently, and which method best fits your situation requires a clear framework. And that is exactly where we need to go next, by examining how different rebalancing approaches work in practice, how to choose between time-based and threshold-based methods, and how to integrate rebalancing into your investment routine, without turning it into a source of constant friction, which brings us directly to the next part, where we will continue by looking at when and how to rebalance in practice, because execution is where most good intentions quietly fail. The first decision is choosing a rebalancing trigger, and there are two broad approaches that work when applied consistently. Time-based rebalancing uses a fixed schedule, such as quarterly or annually. Its strength is simplicity. Decisions are made on the calendar, not in response to emotion. This reduces overthinking and makes rebalancing easier to maintain over decades. Threshold-based rebalancing, on the other hand, activates only when allocations drift beyond predefined ranges, such as 5 or 10 percentage points from target. Its strength is efficiency, because it responds to meaningful change rather than routine. The trade-off is complexity, because ranges must be defined and monitored. Neither method is superior in theory. The better choice is the one you will actually follow without hesitation. How you rebalance matters as much as when. The least disruptive method is cash flow rebalancing, using new contributions dividends or withdrawals to nudge the portfolio back toward target weights. This approach minimizes transaction costs and taxes, especially in taxable accounts. When markets are rising, directing new money toward underweighted assets restores balance quietly. When markets are falling and withdrawals are required, drawing from overweight assets achieves the same effect. This method is slower, but it is often the most tax-efficient and behaviorally comfortable. When cash flows are insufficient, direct trades may be necessary. Here, rules are essential. Decide in advance which assets will be trimmed and which will be added, and by how much. Avoid partial hesitant adjustments that reflect discomfort rather than discipline. Rebalancing works because it is decisive within limits. Half measures often fail to correct risk and invite second guessing. That said, rebalancing should respect asset roles. Core holdings deserve consistent treatment. Tactical or satellite positions may warrant wider bands or separate rules, so that rebalancing does not unintentionally dismantle the strategy. Taxes require deliberate integration. In taxable accounts, harvesting gains to rebalance can create unnecessary drag. This does not mean taxes should paralyze action. It means rebalancing should be coordinated, with holding periods, loss, harvesting opportunities, and account types. Many investors place tax-inefficient assets in tax-advantaged accounts specifically to make rebalancing easier when it matters most. This foresight pays off during volatile periods when the need to rebalance is highest and emotions are loudest. Costs and liquidity also deserve attention. Rebalancing should not force trades in illiquid assets at unfavorable prices. For assets with wide spreads or high transaction costs, wider rebalancing bands may be appropriate. The objective is risk alignment, not mathematical purity. Precision that ignores friction often underperforms simplicity that respects it. Perhaps the most difficult aspect is emotional execution. Rebalancing asks you to sell what feels safe and buy what feels broken. This discomfort is the signal that rebalancing is doing its job. Investors who wait until it feels comfortable often miss the window. When rebalancing adds the most value, this is why rules matter. When rebalancing is rule-driven, discomfort becomes irrelevant. Action follows process, not mood. Over long periods, rebalancing also evolves. As life stages change, target allocations change, and rebalancing reinforces that transition. Early on, it may steadily increase exposure to growth assets. Later, it may gradually reduce risk. In both cases, rebalancing acts as a bridge between intent and reality, smoothing transitions that would otherwise feel abrupt or emotionally charged. In the end, portfolio rebalancing is not a return-enhancing trick. It is a risk stewardship practice. It keeps portfolios honest, aligned, and resilient. Investors who rebalance consistently may not always outperform in strong markets, but they tend to avoid the extremes that cause lasting damage. Over decades, that avoidance compounds quietly into better outcomes than brilliance ever could. If this framework helps you see rebalancing as a system rather than a reaction, consider subscribing to stay with these long-form discussions focused on disciplined investing through cycles. And leave a comment sharing which rebalancing approach you feel most likely to stick with, because consistency, not cleverness, is what ultimately keeps portfolios on track.